DeFi has recently become an important concept to discuss in the world of cryptocurrency and blockchain technology, but what exactly does it mean? This video will cover everything you need to know about DeFi, including what it means, why it's important, and how it's changing the way we approach money in the digital age. Traditionally, the transfers of funds has been handled through centralized finance, when a central authority controls the distribution of money. The government and the banks oversee it. They never say that they are, but they do. They can make more of it if they need to. It is impossible for them to prevent you from doing it if they want to stop you. They may refuse to give you an account if they don't want you to. So at any time, they could have your money and they could keep it too. And when it comes to a dispute, it can be pretty difficult to argue the opposite side. Like, how could you prove to them that you gave them the money? They base their friendship on trust. In addition, if you run a business, they have rules in place that restrict your finances. For example, if you have a little herbal medicine tree business, they can say that you can't deposit any of that money that comes from your business in the bank. In this sense, cash will be both limited and allow you to do anything. For example, you can deposit money, invest it, or keep it safe. That's not all. Traditional finance can be expensive, from high-interest payday loans to credit cards with APRs that often top 25%. Loans may cost you 18% of your borrowing amount, but high interest rates can be justified if it means you can afford what you need to. The alternative is decentralized finance, where there are no banks. Instead, blockchains are run as nodes and serve as decentralized financial system. Anyone can use them, and they don't need your trust because they're code running a program. You may check through it if you want, just to make sure that it isn't going to scam you. They are also resistant to censorship. Finally, they are much cheaper than the more traditional centralized finance system. Decentralized finance, or DeFi, stands for the use of cryptocurrencies and smart contracts to create financial instruments that are decentralized and peer-to-peer, without having to rely on anyone, company, or party. This can offer a range of benefits, such as allowing people to easily borrow and lend without an expensive bank's or credit cards company's assistance, and without compromising financial privacy and freedom. With DeFi, you can act as your own bank, printing money whenever you need it and investing it in anything you like, all with the advantages of blockchain technology. Additionally, DeFi refers to the use of open source and decentralized blockchain platforms as an alternative to centralized financial institutions such as banks and brokerages. DeFi will connect people who have capital with those who need it, by creating an open source decentralized finance platform that enables the creation of financial products that are globally accessible, low cost, transparent, and trustless while reducing the friction often associated with lending and borrowing funds between two parties. Decentralized finance is based on three essential elements: cryptography, blockchain technology, and smart contracts. We highly recommend you look into them if you don't know what they are. This will be a bit of a longer video because it's a big and broad topic. Anyways, so as long as you know about cryptography, the blockchain, and how smart contracts work, let's dive into the 5 pillars of decentralized finance. First, a stablecoin bridges the gap between decentralized and centralized finance. It's a cryptocurrency backed by a real-world asset. For example, DAI, Tether, and USD coins are all called stablecoins. This is because their prices are pegged to the US dollar. Consider this example. A new US dollar coin is minted every time you buy one for $1. Withdrawing one produces a dollar coin worth $1 in US currency. Basically, this purpose is to provide a dependable way to buy and sell specific coins without uncertainty. To compensate for this problem, we can simply exchange one set of items for another. Here's an example of how this might be beneficial. The price of one Ethereum went from $700 to $1,000. Additionally, because you have stablecoins, you have to sell your Ethereum at a centralized exchange like Coinbase or Binance. They're willing to exchange a US dollar for it, but you'll need to be patient because they need to make a profit for themselves, so it may take a little time. So if you make money from trading or selling, the IRS expects you to pay tax on your gains, and Coinbase and Gemini will let them know all about it. Your next step would be to wait for Coinbase or Binance to deposit them into your bank account and then withdraw Ethereum from your bank because you want to keep your funds safe. 4 months later, Ethereum drops to $350. When the price of Ethereum gets close to $700, you withdraw $1,000 and use it to buy 4 Ethereum. You hold the 4 Ethereum until they get to be worth more than the original $1,000 you put in. Then you sell them. So you send it off to the centralized exchange, bear the cost, and then wait a few more days for it to appear in your bank account. If you're looking at this example, there are fees, taxes, and long wait times. But what if we utilized a stablecoin cryptocurrency like USDC? Imagine you bought one Ethereum at $400, and then it went up to $800. So you trade your one Ethereum for 800 USDC instead of going through all that headache. Then it drops to 200 USD. And so you just hold it, similar to the previous example. For instance, if you trade $800 in USDC for 4 Ethereum, and then Ethereum jumps to $500, now this is the profitable part. In just 5 minutes, you convert your 4 Ethereum to $1,600. The fees were less than 1%, but because of it, you could trade almost instantly, and your funds were secure with a decentralized exchange, and you believe it because it's just a code. It never changes. Unlike sites like Coinbase, Binance, or Gemini, which are in part regulated by the government and owned by the people, they have been hacked before. Getting back on topic, that's the purpose of stablecoin. You can engage in the cryptocurrency sphere without having to rely on your government-issued bank. A lot of us in the US take banks for granted, but some countries are now severely limiting the amounts of money or the types of currency people can use. In the United States, bank authorization is required for transactions over $10,000. Meanwhile, using a stablecoin like USDC, you can transfer $10 million in value for $5. You cannot do that with US dollars. Second on the list of benefits of decentralized finance are lending and borrowing. In actuality, a big part of our financial circumstances comes from borrowing and lending money. As such, it would make sense that the blockchain could perform these actions more effectively. It's possible to lend and borrow money with banks because we usually provide 20% collateral, some of which the government can recover in the event that we default on our payments. In other words, failing to repay a loan is an open and shut case. When it comes to cryptocurrencies, this is a drawback because one of the perks of cryptos is anonymity. This could happen to you when you put 20% down, run away with the rest of the loan, and never be seen again. As a result, we need to find a way to resolve this. The invention of the smart contract would allow us to do so because, as you may know, it gives us the power to allow other parties to utilize our funds without giving up any of the custody rights. To make this clear, I'll give an example. Person A wants to earn interest on his coins, while Person B wants to borrow some coins. To recap, Person A goes to a compound, which is a platform that enables cryptocurrency borrowing and lending, and Person A deposits his coins into a smart contract. You see, smart contracts are just computer codes that carry out specific functions. If he wishes, he can make C tokens or A tokens and get a smart contract for an added level of security that calculates and earns his original deposit plus interest. So the smart contract ensures that no one has to do the calculating or execute the transaction, as it's all done by a set of programmed commands. This means that Person A wants to lend money, and Person B would like to borrow money. For the lending side, Person A needs to have enough collateral to have collateral. And on the borrowing side, Person B needs to borrow enough to put up at least as much collateral as needed. If Person B needs $200, he will need to borrow $240. Therefore, if Person A were to default on their loan, the smart contract will reimburse them plus interest. This way, they can recover some of their losses. In addition, if Person B fails to pay back his debt in time or doesn't pay back his debt at all, then Person A can retrieve his original deposit plus interest from a compound platform. By now, you already know how loans work in a DeFi world, but there are still some questions in your mind. And if you want to clear them up, you should watch the second half of this video. We will talk more about DeFi and explain borrowing and lending in more detail. And we still have 3 more pillars of decentralized finance to discuss. You can find the link to part 2 of this video in the description box below. Let's continue exploring the DeFi world. This concludes our video. Before you close this video, please subscribe to our channel and hit the notification bell so that you'll know when we post new educational videos on cryptocurrency and other related topics.